Good morning and welcome to Armanino's webinar, the SOX Annual Update. We are going to be helping you to work to stay ahead of the compliance curve. So first of all, I'd like to review how to use your webinar pane. You'll see in the upper right-hand corner of your screen a box with an orange arrow. To expand that box, just click on the orange arrow and you can type in a question for our presenters at any time. Hit the send button and our presenters will answer those questions as time allows at the end of the webinar. Secondly, make sure that you have the right audio settings selected. If you're calling in with your telephone, select telephone. If you are using your computer mic and speakers, please select that button. This will help you decrease the echo sound. To qualify for California CE, you must use a personal computer, no PDAs, and log in with your own information and unique URL. You must be logged into our online software for at least 50 consecutive minutes within the scheduled time frame of the webinar. Actively respond to at least 75% of the polling questions and complete the evaluation survey at the end of the webinar. I would also like to introduce our presenters. First, we have Laura Wong. She's a senior manager in our governance, risk, and compliance consulting practice. Laura has 8 years of public accounting and 2 years of industry experience in financial, operational, and IT internal audit, SOX, ICFR optimization, and third-party reporting. Our second presenter is Brian Peterson, a senior manager with our GRC consulting practice, and he's got more than 7 years of financial accounting and compliance-related experience. Brian's prior experience includes GRC roles with a Fortune 500 tech firm, managing SOX compliance over revenue and IT general controls, and additionally, he has extensive experience with operational and IT audits. During our webinar today, you will learn to identify the state of SOX compliance, evaluate current areas of focus and proactive measures you can take to stay ahead of the compliance curve, and consider emerging areas that may require further input and investment for your organization. We are going to cover some of the top areas that we will focus on include the Staff Audit Practice Alert number 12 and 13, PCAOB AS18 related parties, cybersecurity, increasing automation, flowcharting, and a continued focus on Staff Alert number 11, particularly IPE and MRC. And with that, I'm going to go ahead and turn it over to you, Glenn.
Thank you, Mary. Good morning, everyone. Thank you for participating today. Happy St. Patrick's Day. Happy March Madness Day. It's one of my favorite times of the year. Staff Alert, if you tuned in last year, you got a lot of Staff Alert 11 from the PCAOB. That's the alert that brought you the greatest hits of management review controls, MRCs, auditor failures around IPE, information produced by entity. It covered a broad array of SOX topics, pretty much covering the full landscape environment of financial reporting. And it seems with Staff Alert number 12, the PCAOB is somewhat narrowing their focus a little bit into the individual process level, namely revenue at this point. So without further ado, Staff Alert number 12, matters relating to auditing revenue in an audit of financial statements. This was issued September 9th, 2014, about a year and a half ago. And as is the case with these alerts, there's always some latency between when these things are published to when they trickle into our daily audit lives. However, I do think that this is a little bit more directly impactful than Staff Alert 11, which took a couple of years to really kind of get that inertia going and changing the way we do our behaviors. Some of the drivers behind this alert really obviously is revenue, the significance of revenue. It's one of the most important financial figures in our financial statements. It drives EBITDA, drives net income, spills over in the balance sheet with retained earnings, and not to mention, a lot of executive and management comp is tied to revenue figures. and with that, exposes a significant fraud risk, which is another driver behind this. In the alert, the PCAOB mentions a couple of times a COSO study from 2010. As part of that study, the COSO researched 347 companies over 10 years and found that 61% of those had incorrectly recognized revenue. And what was more alarming was the fact that a lot of that was due to recognizing revenue prematurely, or in many cases, false transactions were being fabricated. And then, on top of that, another key driver is the annual inspections by the PCAOB. They are continuously noting, auditor failures over revenue recognition. The failure to evaluate proper disclosures, failure to address fraud risks, as mentioned, placing reliance on controls that are inefficient and not sufficiently testing your statistical sample as part of your financial statement audit, not testing IPE for completeness and accuracy. So a lot of the highlights are kind of listed on the slide, and I won't go through, and what we'll do is we'll do kind of a 30,000-foot pass over for each of these items, but they kind of flow under two broad categories: one, testing revenue rec, presentation and disclosure, and then your miscellaneous, other aspects of revenue recognition. So the first item we'll touch on is revenue for testing revenue over contractual arrangements. This, speaking personally, I've seen a big uptick this year in auditor scrutiny over items like multi-element arrangements, ensuring that you're properly recognizing revenue in accordance with the contracts. Identifying, do you have standard contracts? Do you have mostly non-standard contracts? What are the contingencies with those non-standard contracts? And are you meeting those contingencies prior to recognizing revenue? So there's a lot of auditor failures here PCAOB identified with appropriate testing over this. And, as well as any sort of estimates, as with construction and production types, estimates complete, seeing unnecessary accelerations of those estimates and thereby prematurely recognizing revenue. So what are the recommendations? The recommendations are pretty straightforward. Essentially do your due diligence, understand your company, understand the company's products, the company's strategy, and that should help you understand the company's contracts. Do they have a lot of complexities with those? Is there a lot of non-standard terms and conditions with those? How do they carve those out as to those with standard terms and conditions? And what are the revenue controls in place to perform that and appropriately recognize for each category? So appropriately evaluate the revenue controls. So the next item they covered really is revenue cutoff procedures. Testing whether revenue was recognized in the correct period or not. And essentially what they found was the proper evaluation of material misstatement wasn't being performed in many cases. They're not understanding the complexities with auditors aren't understanding complexities with revenue. Are there a great number of transactions, or are there just a few large, more significant numbers? Are contracts complex? Are they simple? These are things that you need to assess and then appropriately map your test procedures around. In particular, they talk about not testing IPE for completeness and accuracy. And some of the recommendations, one is pretty basic. Identify the risk. What's the risk of fraud and the risk of error? Come up with your overall risk level, and implement procedures to appropriately address that. One obviously procedure is test, transactions within the period that you're testing, as well as the subsequent period. Ensure that everything is appropriately accounted for. Next item they touch on is about required revenue disclosures. Just a few bullets here. A lot of what their issues are that they found, again, around multiple element arrangements, warranty policies. Are those in conformity with GAAP? A lot of omissions over new service lines. Usually, there's a lot of ambiguity there. Management likes to keep their cards close to their vest. So their recommendations, the key point being, develop expectations for what management's disclosures should look like. And if, management's disclosures don't meet that expectations, appropriately question it. Next item is around responding to the associated fraud risk with revenue. And as discussed, there is a significant amount of fraud risk associated with revenue. And what they found was, obviously in COSO, they noted a lot of examples of fabricated transactions, recording transactions with unresolved contingencies, improperly accelerating estimate to complete percentages, shipping goods that were never ordered. As well, what the PCAOB points out is issues identifying the risk of fraud, understanding the complexities involved in revenue transactions, and then obviously issues, mapping your appropriate test procedures to cover that risk. One of the points around that they pointed out, the PCAOB pointed out, is around the side agreement controls, whereby your sales organization certifies that they don't have any alternative agreements on the side. And what they noted was, in several cases where they would get non-responses back from management, auditors would essentially perform inquiry alone and wouldn't follow up with any more alternative procedures. So their recommendations, obviously, apply appropriate professional skepticism. Always presume there's a fraud risk. And evaluate. For all types of revenue transactions, evaluate the fraud risk associated. Vary your test procedures. The nature, timing, extent. Select samples that are out of the ordinary, that are smaller, a little less material. Try to mix it up. Evaluating controls over revenue. What they found here, as part of the financial statement on it, there's a reliance placed upon controls which helps you reduce your statistical sampling. And so what they found was a lot of insufficient testing. As a result of this, they noted a lot of controls were deficient, yet statistical samples and the risk assessment was never updated appropriately, leaving for insufficient testing over your financial statement on it. A lot of deficiencies with identified controls, and a lot of controls that were improperly designed and didn't cover the assertions that the auditor was trying to test for. Also, testing for over the full period of reliance was another issue, which is in line with their recommendations. Obviously, ensure that you evaluate the design of the controls. Do they cover the associated risks, associated assertions? Are you testing over the full period, or are you just covering half the year, but you're relying on it for the full year? Evaluate also the severity of the deficiencies. So the last little bullet to note on Staff Alert 12 is around controls over revenue with multiple locations. And what they noted here was, improper reliance on entity-level controls that proved deficient, improper reliance on an internal audit function, not really evaluating the risk associated with another business unit or a multiple location. And that's really the theme here is, assess the risk appropriately and map your procedures to the associated risk. If those procedures require, if that risk is high in another location, you should map your testing at that location to cover that risk. And they point out to auditing standard number 9, which gives guidance on auditing over multiple locations, and as well as I believe guidance over relying on the internal audit function. So ultimately, the theme here really is around, evaluating the risk appropriately, doing your due diligence with complex revenue transactions. From a SOX perspective, an internal audit perspective, are your controls designed appropriately to mitigate the risk of improperly recording revenue? From an external audit perspective, are you evaluating the associated fraud risk, the associated risk of error appropriately, and then are you performing properly designed test procedures to cover that risk? And just a little caveat, just a little caveat on that point. These are pretty high-level bullet points here, so if you haven't done so, please, read the alert, especially if you are an auditor or an auditee, and if you have anything to do with revenue. Staff alert number 13 was very brief, and I will keep it, somewhat high level. Really, it just provides guidance over the going concern principle for external auditors. Right, the traditional guidance around audit update 341 allows auditors to evaluate whether the need to include an explanatory paragraph in their report over, potentially the company's ability to not continue as a going concern. But with the update to the Accounting Standards Code, ASC 205 now requires management to perform that assessment as well and disclose that in their financials. And as part of that, requiring the external auditor to evaluate the disclosures. Are they presented fairly and in conformity with GAAP? But the alert does mention, obviously, that 341 is still in play and still should be used to evaluate the need for an explanatory paragraph. And I think that should cover the staff alert 12 and 13 update. Again, those are just brief updates, and please read the alerts on your own.
Great, thank you, Brian. And now we are headed to our first polling question. So, has your company reevaluated your controls over revenue due to staff alert number 12? You can select yes, we've reviewed and updated. Implementation is in progress. C, it's in review. And D, it is not yet reviewed. So we'd like you to make sure that you put in your votes because, again, your participation in these polling questions is what grants you CE credit for participating in this webinar. And another note, we will be sending you a link to the recording and the webinar slides so that you'll have them for review in 3 days, business days after the webinar. So again, we've got a few people still left to vote. So the question is, has your company reevaluated your controls over revenue due to staff alert number 12? A, yes, we've reviewed and updated. B, implementation is in progress. C, you're in review. And D, not reviewed. So we'll go ahead and close that poll. And Brian, are we surprised by these results?
Not really. With these staff alerts, like I said, there's a lot of latency with them. But as this is directly applies to recognizing revenue, it certainly has had an impact this year, and I certainly would see this coming in play next year for everybody.
Okay, thank you. And then we will move on.
Thank you, Mary and Brian. With further ado, we are now going to be reviewing the new PCAOB standard, auditing standard number 18, regarding related parties. So why AS18? AS18 was developed by the board in terms of the backdrop with several decades of financial reporting frauds involving companies' relationships and transactions with related parties, significant and unusual transactions, and financial relationships and transactions with executive officers. The standard was really designed from an audit perspective for auditors to evaluate a company's identification of and disclosures of relationships and transactions between the company and its related parties. This standard was released by the PCAOB in June of 2014, and the standard was asked by all public companies to enforce by the end of last year, so December 31st, 2015. So the standard is pretty lengthy, but I've tried to condense it for everyone to have 5 top takeaways related to this related party standard. And the first takeaway I would like to share with everyone would be perform expanded inquiries of management and at the board level. So as us auditors going out to our clients, this standard we would need to perform more inquiries with management compared to years before where we didn't need to as much. The second point would be obtaining an understanding of the company's processes and controls associated with related parties and significant unusual transactions. Third would be testing and concluding as to whether the related party and significant unusual transactions have been identified completely and have been accounted for and disclosed appropriately. So this is where in the previous years we didn't have to go and test as much, and this AS18 standard will involve a lot more testing in terms of completeness and accuracy as to how does management gain comfort that they have absolutely and completely accurately disclose all related parties and significant unusual transactions during the year. So us as auditors would have to do, as I pointed out in the first 2 bullet points, where we have to do expanded inquiries and then also doing due diligence and really understanding what are the controls that management has in order to be able to disclose this information. Number 4 would be communicate findings directly to the audit committee. So unlike previous years as well, this standard actually has the external auditors communicate their findings directly to the audit committee. And what's also should be noted as if once the external auditors do find any findings or so, they're automatically noted as a deficiency. So there isn't really a remediation that could be put in place for that year. The last one would be to obtain additional management representations about the completeness and accuracy in identifying and tracking all related party relationships and transactions. So that's kind of what I've already touched. And number 3 is, again, I would like to emphasize upon the completeness and accuracy, since this type of standard, this area is not as easy as some other areas to test completeness and accuracy. So it's a lot more qualitative in nature, where inquiries, corroboration, and involving management and other higher external parties to really be able to opine on the completeness and accuracy. And with that sums up our auditing standards number 18, and we will now be going to polling question number 2.
Great, thank you, Laura. Okay, this is a simpler one. You've only got 3 choices. So has your company aligned to AS18 related parties and the directives there? So your answers are yes, no, and not sure. And we'll give you a couple of, 30 seconds or so here to register your vote. We want to make sure we do get everyone to vote. Let us know. All right, the polling question going one more time is, has your company aligned to AS18 related parties? Yes, no, or not sure. And with that, we're going to go ahead and close the poll. So Laura, how would they find out if they're not sure, if they've aligned?
Well, if they're not sure, that's probably going to be where they would need to ask their management if it's the client perspective. From an auditor perspective, we should be able to know if we've done procedures or not. So for the ones that are no or not sure, I would urge on the client side to make sure you speak with your legal counsel as well as management in terms of what we have done, what we have in place in addressing how related parties are accounted for SOX.
Great. And now we're moving into the topic of cybersecurity.
Yes, everybody's favorite hot topic, cybersecurity. I'll be honest, when I first heard of the link, obviously the SOX link to cybersecurity, I was a little confused. I didn't understand why hackers would want to try to attack your ERP to post into your general ledger. But that's not it at all. Really, it's around presentation and disclosure of the risk, the associated risk, right? And as we see, there's a considerable, there are many types of costs associated with cyber attacks, and there's a considerable volume, considerable amount associated. I noted here from Target in 2014 had a $250 million expense associated to their breach from late 2013, and they only increased after that at that point. And some associated costs here, obviously reputational costs, the damage to potentially losing your customer base, losing a significant amount of revenues, potentially losing your business, increased detection costs. Are you under constant barrage? Do you have to outsource a security team or hire one internally? All that. You need internal software, networking software, and a lot of remediation costs. If you have victims of a breach, lose some PII. How do you identify those victims? And litigation costs associated with that as well. The SEC has published some guidance, to date. I mean, this is still really preliminary. I think they have the Division of Corporation Finance has issued CF disclosure guidance topic number 2, which is a pretty good summary and pretty good guidance on how to disclose and what to disclose. And essentially, it's about giving enough information to investors to be useful, but also not providing a roadmap to hackers and publishing something that's going to potentially be used against you, right? Some of the items that they point out for guidance, registrants should evaluate and disclose their risk level. And then they should also disclose significant incidents, the severity and the frequency, as well as future probability, severity and frequency. Avoid boilerplate, generic disclosures. And also one key thing is with Target, what's the risk associated with some of your vendors, as is the case with them. I believe it was their HVAC vendor that initiated the attack or social engineering through them. So just, if you aren't familiar with, the cybersecurity risk profile or assessing cybersecurity risk, there's first step really is to develop your inherent risk profile. What are your systems? What are your external facing systems? What are your delivery channels? Perform the full analysis. Identify, on an annual basis, update this. Which systems are going to undergo significant changes? Do they have changes in the user base? Either an increase or decrease. Keep that evaluation as an ongoing process. And then evaluate, your policy against it, your cybersecurity maturity. How are you complying with applicable laws? How are you mitigating the associated risk that you identified in your profile? And these are really the keys to cybersecurity, right? It's threefold. One, perform the proper evaluation of the associated risks, and once you identify that, implement the appropriate policy to mitigate that risk. And then 3, identify what's the appropriate disclosure to disclose to your, stakeholders. I think that's about it.
All right, and so we've got a polling question about cybersecurity here. So does your company disclose any items related to cybersecurity in the published financial statements? So your answers are yes, no, low impact. We're not concerned, I guess, about the cybersecurity risk. Not yet. We are planning on doing so, and not sure. So again, let's have everyone register their answers here for this polling question so we can make sure to give you credit. So the question again is, does your company disclose any items related to cybersecurity in the published financial statements? And with that, I think we'll go ahead and close the poll. Looks like we've got the majority of folks voted here. So is it surprising that nobody is doing this?
I don't know that that's surprising. I mean, it's still kind of a relatively new phenomenon. I will say that it's certainly more impactful than people think, especially, we're here in the Silicon Valley and there's a lot of tech companies, right? And not just the exposure to reputational risk and all that, but also proprietary software. If someone were to end up in the wrong hands, your business model and your business could have potentially be unseated. So I would say that maybe people aren't doing the appropriate evaluation at this point.
Okay. All right, and we're going to go back to Laura now with a further spotlight on ICFR.
Thank you, Mary. So looking further into ICFR, if we go into what are some of the hot topics that the PCAOB have been concentrating on, and our friends, the external auditors as well, would definitely be increased automation. So with this type of era going on in terms of everything going automated, virtual, and us being in the hub of Silicon Valley right now, we really want to think about how we can better increase automation for our clients. So in the extent of manual and automated controls used by the company, we will want to consider ITGC. So really looking back and scrutinizing our ITGCs, like digging down into where are we focusing on, where we may be light in areas, where we should be increasing areas to help automate as many controls as we can from the manual side. Secondly, would be ensuring the completeness and accuracy of system-generated reports. So that's been discussed in the last few years with Staff Alert 11, with IPE. So we want to continue ensuring completeness and accuracy and testing our system-generated reports, collaborating with our auditors from the client side, really doing those report validations where testing all the key reports that management is relying on from control perspective. Number 3 would be manual controls utilizing system-generated reports. So that's bridging on my last point, where really using and understanding the controls that are governed around gaining comfort over what's the data going into this report that's generated in the system. Lastly would be understanding your system limitations. So obviously, with relying so much on the systems, really understanding where system limitations may be, and either finding compensating controls manually that can help bridge that gap, until number 2, which is finding another add-on or working with your service provider to see what kind of additional areas that can be developed to bridge that system limitation to enhance the system capability. The next slide, I would like to focus on improving control reliability from manual to automated. So when transitioning from manual controls to automated controls, and for our auditors out there and even our clients, we know that manual controls absolutely have the majority in our SOX control rule set. Usually we see about 30 to 40 ITGCs, and now compared to finance and operational controls, we're near the hundreds. So when transitioning, number one would be identifying opportunities with ERP systems. So there's a lot of great ERP systems that most of our clients are on, where we want to identify opportunities where we see some of our manual controls and where those can be automated into a test of one, or a testing as a configuration type control. Number two would be automating GL account reconciliations. And I've definitely seen a big trend with a lot of clients, which is really good, where they use account reconciliation type of software like Blackline, and we see that a lot. We see AFRM and so forth. That's really helped the client in terms of saving time with operational accounting, with accounting close, with a SOX compliance as well, where all these reconciliations that were done on Excel historically is now being automated, and it's interfacing with the GL and so forth, and various other systems and modules that do an automatic completeness and accuracy check. Number three would be partnering with SaaS providers. So in partnering with your SaaS provider, you can understand better the system in terms of, key areas, high risk areas like revenue and commissions and so forth, that you can have them built, maybe customizations, or even or maybe even canned enhancements, where that would really help take manual controls that have been previously done and automating them in the system that you're using. Number four would be working with third-party information providers to automate reporting. So that's where we see, our SOC reports and so forth in terms of their, and also it may also be other third-party reporting representatives, where we can have them help us in terms of automating all the reports that are generated. And then the next point would be utilizing system exception reports as well. So that's a good point, where I've seen a lot of systems now that have new features. One client I was talking to the other day was saying ADP now has an exception report that, usually they would have a lot of manual intensive supporting documentation that they would need to verify against the system. But now the system has been enhanced with some exception reports that really save time and ensure completeness and accuracy. The last one would be automating report runs. So we see this already in much of our IT general control testing, where there's automated reporting runs, where there's not going to be as many human interventions that kick off batch jobs or job scheduling and so forth, where now if you have automated job, they run the reports on a schedule, on a frequency as determined, can be weekly, daily, and so on. Great. Now, with summarizing the system automation and manual controls, we're now going to go into flowcharts, which is our next topic. So flowcharts has been definitely another trend that's been beaming in the PCAOB eyes in terms of capturing all our design work. So flowcharts is great. I like to summarize it as, a picture is worth 1,000 words, right? And in an auditor perspective and SOX perspective, flowcharts are pictures that we draw for our clients. And a flowchart is great because it really helps identify process gaps and duplicate procedures, bottlenecks, and areas of risk in financially significant areas within a business that a narrative or a walkthrough or so forth may not be able to capture. It helps bridge better understanding by the end user. It helps identify key controls in place, understanding how controls flow within a process, as well as also including systems and other interfaces and the flow of data. And also my last point would be also identify where the what can go wrong is in this whole picture within an operational financial process. Going on to our next slide, I'd like to go into some basic principles when flowcharting. So if flowcharting is new to you, or if you're a pretty advanced flowcharter, some of the basic principles I'd like to share with everyone would be, number one would be apply a consistent methodology. So when creating a flowchart, either from scratch or revising it from year to year, you always want to make sure that the flow of the transactions are always from a top to bottom or a left to right approach, using standard symbols to capture the key inputs and process activities and key outputs, and using a top-down approach to identify the risks as well. The second one would be identifying the process. So you want to make sure that significant counts and disclosures are determined under the process. Using a separate flowchart for each process is also extremely helpful, especially when there's more than one processes that would need to be broken down to help the reader understand what's going on. Number three would be defining the process boundary. So you want to make sure you identify the beginning of the process. So for example, the initiation of a transaction, if it's initiating a wire or so forth. And then endpoints would be recording that same wire transaction in the general ledger of the process. Next, we would want to consider using rows that depict areas of responsibilities for cross-functional processes. So that's where using swim lanes would be very helpful. We want to make sure that we're able to clearly and visually separate how different business units in a process are involved. So having them in a swim lane would better be able to depict that picture. And in the next slide, we'll be able to have a better, sorry, not the next slide, but a few slides after, I'll be able to show everyone a better pictorial of an example flow chart. And the last point I wanted to express would be following the transaction data flow. So the focus should be always capturing the key steps or activities within the process that impacts relevant transaction data. So moving on from basic flowcharting convention, identify key steps in the process of the flowchart. So we're going one layer down. The first one will be identify the initial inputs to the process. So an input is usually generated from a computer, or it can be from, depending on the industry, it can be a phone call, it can also be from a paper trail, from an email. So every transaction originates from three types of sources. So like I was saying, sources outside the entity. So that can be, for example, a bank, department or IT systems not shown on the flow chart. So it can be also from another department within the organization. It can also be a person. And lastly, department or function referenced in the flow chart. So it can be one that if you're using a swim lane, another operational unit from that area as well. Depicting each successive step in the process in a logical sequence. So in this step, it's a description of each process activity should be short and concise, but well enough so that everyone reading your flowchart for the first time would have a good understanding of the logical sequence or the process. Also describing key events, actions, or decisions as they occur. And then lastly, a description of activities should be presented enough detail to understand what is occurring at each step. The third part in identifying key steps would be identifying the IT-related control. So if you remember from my slides a couple ago when I talked about increased automation. So this is a really important part in identifying key steps for flowcharts as well, where you want to identify the IT relevant controls in the flowchart along with the risks and be able to bridge that to the system that it's coming out from, and also how it relates to the manual controls as well. Continuing on our identifying of key steps on this slide, we'll see that the next step would be identifying the key outputs of the process. So the key outputs of the process are destinations outside of the entry, department or IT systems not shown on the flow chart, and then what we mostly see would be going into the general ledger. And the next few points that we'll see will be on our next slide, which really relate to linking and being to identify the what could go wrongs, which are also known as risks to the controls. So here is a very basic flowchart. The purpose I wanted for our audience to see from this picture was how the symbols are, like we stated before, are universal, right? So using one type of symbol convention for each purpose. So if you see the first symbol where it looks like an oval, so that would be an input type symbol. The next symbol, which looks like a square with a little curvy line on the bottom, is actually a paper icon. And then a rectangle would actually be a process. So using that kind of universal convention is very important when streamlining and formalizing your flowcharting practice. And in terms of swim lines, which we talked about as well, you'll see how this particular picture shows 3 different swim lanes that separate the purchasing department from the receiving department, which ultimately all the work gets processed in the accounts payable department. And I also wanted to make 2 more points where if you see at the lower center of the flow chart, the red circle is a what could go wrong, and the what could go wrong is the risks associated with each control. So each control you're going to have in place will be able to mitigate one or multiple what could go wrongs. And then the green circle is your control signifier, saying that this process rectangle is going to be your control activity. Thank you. And with that, we summarize our overview over flowcharts.
Great, and we've got a polling question for you about flowcharts, so hold on just a moment. Again, this is one of our easier ones. So has your company incorporated flowcharts as part of your process design documentation? A is yes, B is no, C is you've partially incorporated them, and D is not sure. So maybe now that they have the steps, more people will be answering yes next year. So great, we've got a good group of you answering. If we can get the last couple of people to register their answers here, that'd be wonderful. Okay, and with that, I think we'll go ahead and close this poll. So it runs pretty even between yes and no, Laura.
Yes, I see that. And I'm not too surprised, actually. I mean, I'm glad that the majority still has yes or partially. That's great. Seems like 56% of the audience is yes or partially, and only 33% is no. I would urge that flowcharting is great in terms of saving time and being a lot more effective for the purpose of documenting your design and your processes and key controls, and really being able to see every time you look at it from a fresh viewpoint, and seeing from a higher level if everything makes sense and if everything's covered.
Great. All right. And we're going to go to our last section of the webinar here.
All right, so the last section of the webinar is really a refresh I wanted to give everyone. It's pretty familiar topics where we've been able to share with most of our webinar audience over SOX and Staff Alert 11 and other type of hot topics that's been in the news in our industry. The first slide here I wanted to share with everyone is regarding evidence. So in staff, if you recall back in our previous webinars, or if you haven't attended those webinars, if you've read excerpts in Staff Alert 11, there's a lot of scrutiny over how the PCAOB is looking at auditors in terms of what type of evidence are they using to be able to test the design and effectiveness over our controls. So previously, we've always been able to do a lot of inquiry. If we recall, if some of you've been in SOX in the early years back in the 2002 2008 timeframe, a lot of it was inquiry and observation. But really now, since SOX has evolutionized over 14 years, that's really not the acceptable method to go now. A lot of our work is now needing to be in that confirmation, reperformance, recalculation. So it's not, the inquiry or observation. We got to, roll our sleeves up a little bit more and really do that reperformance and confirmation and recalculation of those evidence pieces. All right, now going to our next topic that I wanted to revisit would be management review controls. And as Brian said earlier, that's always been one of our favorite topics, management review controls. And with management review controls, there's 4 really basic pieces that I would like to go over that make up how to address management review control. So the first is the intent. So when encountering and reviewing a management review controls, really understanding what is it designed to do? What are you trying to achieve in this particular control? The secondly would be the mechanics. So looking in this management review control, understanding how is it executed? What is the reviewer, or how is the reviewer doing this control? Next would be precision. So the precision would be tied to how the reviewer is mechanically addressing the control, but executing it in a qualitative and quantitative measure. So in a quantitative perspective, what are the thresholds? What is that numeric type of computation that he's using or she's using when reviewing? And qualitatively can be addressing, are they comparing it to a benchmark? What other qualitative considerations are they taking? In fact, is it in light of a certain business impact that has happened, or is a new acquisition, and other type of regards? Lastly would be objectivity. So is the person doing the review part of the processing? So understanding, is the reviewer in this control, what role are they playing in this control? On another topic in relation to additional considerations would be the Reperformance Standard. So the Reperformance Standard is where external auditors would be relying on internal audit for their work. So in terms of relying on the work of others. So when documenting your work, in this perspective would be internal audit or management, if they were doing some of their testing as well. They should ensure that a reasonably skilled auditor would be able to review the work papers and related evidence. So with that said, the work that's being tested for management controls, the external auditors should always be able to understand what was did and why. and they would be able to see the same evidence that we saw or you saw and able to reperform and reach the same conclusion. What they should not need to do would be asking a lot of clarifying questions. So it's natural that external auditors may come back with some review notes, some clarifying questions, but it shouldn't be overburdensome. And they should also not need to request and review additional information to support your testing conclusion. So in conclusion, that's going to bring us a wrap to the 2016 annual SOX update. And during this webinar, I would like to rehash what we covered. So the first topic that we shared with the audience today was staff audit practice alert number 12 and 13, PCAOB ASAT related parties, cybersecurity, increased automation, flowcharting, ICFR additional considerations, specifically IP and MRC. And looking around the corner, we would want to also express potential changes and areas of focus that could impact your business, including topics such as risk assessment deficiencies, more process automation, value-added internal audit, and emerging trends in fraud risks.
Great, thank you. Thank you, Laura. And so now is a great time if you have some questions for Laura and Brian to go ahead and submit them. We've already gotten in a couple of questions, so I'd like to start with the first one, I think, Brian. And that one is, will the recommendations within Staff Alert 12 change after the new RevRec rules come through in 2017?
Yeah, actually, they touch on that in the staff alert. Their opinion is no. Essentially, you'll still need to validate evidence. You'll still need to perform your assessment over risk and error, but just the rules for revenue recognition change.
Okay, great. We got another revenue question, and that is, what type of revenue controls can be implemented to ensure that the RevRec is appropriate?
Oh, yeah, that's a little bit more involved. We're kind of going through that now with a couple of my clients. I don't know about you, Laura, but what we've seen in the past is, somewhat of a high-level revenue recognition control and evaluation. But now what we're identifying is with these complex arrangements, people are applying this to the old control without evaluating. Are we meeting the contingencies? Are we, carving out our non-standard contracts versus our standard? So we're having to implement, and redesign a lot of controls around that process. Do you use a CRM where you can flag non-standard contracts versus standard, and then have automation or an easier process for the standard contracts to recognize revenue, and then a manual, more laborious process for those that are non-standard. It's created a lot of issues. Some clients that I have, all they have is non-standard contracts. So they do a downstream, very manual, very laborious process, and it takes a lot of time and a lot of resources. So, yeah, and also around best estimated sales price, we're implementing a lot of management review controls. Wherever there's estimations, wherever there's assumptions, we have to insert some sort of really high level, not high level, but really tight management review control. Those need to be heavily scrutinized.
Sounds complicated. Okay, great. Well, with that, I'll share with you Brian and Laura's contact information. So if you have specific questions and you'd like to reach out to them, please feel free to email them. And then I want to remind everybody that you will, within the next 3 business days, receive an email with access to your certificate of completion for your CE and a link to the recording and the webinar slides. So you can see how those flowcharts work and maybe start to implement those. And we thank you for joining us today.